So it's 7:03. So thanks for joining us tonight. So I think today's one will actually be really interesting, whereby it's the question on everybody's mind. So Ritesh heads investment advisory here at Syfe. So he'll be going through tonight's topic. It's actually Q4 2020 market outlook. So I think this will be an interesting session. So do stay tuned all the way to the end, whereby there will be some promo codes given away at the end as well. So over to you, Ritesh.
Hey, Melvin, thanks a lot. Hi, everyone, for joining us today. This is Syfe's quarterly outlook. We have been doing this for the last couple of quarters, and it's been a really, interesting ride and a roller coaster of a ride per se in terms of how the markets have come through and how our own, investment sentiments have, sort of transformed over time as well. So today's topic is recession to recovery, and the thing to mind for everyone to mind is it's a long road ahead. Things are not back to normal. And while the economic recovery has got its leg right now, the road ahead will be bumpy, and we need to be prepared for the volatility that lies ahead as well. So in general, after a deep plunge in the first half of 2020, where the US GDP contracted by more than 32.9%. That was the Q2 GDP contraction. The global economic activity seems to have rebounded as more and more lockdowns have eased. But with the pandemic still spreading and accelerating in places, many countries have slowed their reopening. What this also means is, while there has been a swift recovery in certain countries such as China, which is surprised to the upside, the global economy's long ascent back to pre-pandemic levels of activity remains challenged and is prone to setbacks. So we need to be aware of this as we move ahead. Now, today's session, what are the things that are top of mind for investors? Number one, what is the path to economic recovery? When will we see the functional end of the coronavirus? And post that, how will the new world look like? There have been cases of virus resurgence across the world, particularly in the US. There are uncertainties related to the US election, so we'll cover a little bit of that in terms of what things can you expect in terms of the different outcomes that might happen from the US elections. And given how big the rally has been in the stock market, the question on top of everyone's mind is the stock rally over? Or has it got more legs to continue its uptrend? So combining all of these things together, what is the right investment strategy for all of us going forward? That's, I think, one thing that everyone wants to know. How do you prepare for this uncertainty? How do you position your portfolios to remain resilient as the market remains volatile, right? So we'll cover some of these aspects as we move forward. So in terms of agenda, we'll quickly cover the market snapshot for 2020, like, how has different asset classes and geographies fared till the first half or, the first 3 quarters of 2020? What is the path to economic recovery and risks and implications of, say, the US election, the COVID resurgence, and how do you sort of position your portfolios to invest during these uncertain market environments? And we'll wrap it up with sort of introduction to Syfe, our different portfolios, how you can utilize them to position yourself to achieve your long-term goals, as well as staying invested through these uncertain times. We will also have Q&A session at the end of the session. But throughout the session, as well as we cover different topics, feel free to raise your questions in the chat box, and Melvin will take them up as and when they come in, and inform me as to what those are, and hoping that we are able to answer as many questions as possible during the session. All right. So in terms of market snapshot, if you look at the most followed index in the world, that's the S&P 500. As I was saying earlier, it's been a roller coaster of a ride, and started off the year on the back of a 10+ year bull run, where the market never looked back and it kept on grinding higher. But come 2020, there were already talks of the market forming a bubble, and there would be some sort of reason for the market to come down. But no one sort of believed that it will be because of a pandemic rather than anything that was more structural in nature. So it's really been wild ride for 2020. The S&P 500 dropped by 34% in February and March during the peak of the crisis when the virus was spreading across the globe. But what is even more surprising is the kind of recovery that we have seen post the drawdown of 34%. Once the market started going down, the governments across the world took measures to stimulate the economy and bring it to a state such that the effects of this pandemic were reduced to a bare minimum. These included monetary stimulus programs, fiscal stimulus programs, a lot of government spending, and all of these sort of resulted in the markets, sort of replacing all the demand loss that was seen with all these spending measures, which resulted in direct credit of benefits to individuals and households and businesses as well. And that is what has led the rally so far in the second half of the year, where the markets have rebounded since May 2020 by more than 20%. But I think come September, the rally has started to fade out a bit, given the uncertainty going forward in terms of the US elections, which is right on the anvil, the coronavirus resurgence cases, and in general, the geopolitics surrounding the global economy as well. So all of these are things that is top on our mind as well in terms of where the markets are. If you look at the overall setup, if you were starting this year in 2020 and right now, the markets year-to-date change is flat. It is 1.25% up. So if you were not invested, essentially you would have not seen any of this, but you would not have missed out a lot. But if you did invest, you would have had this whole ride through. And I think what is more important to notice over here is that as a long-term investor, we should always have this in mind that markets will have its volatile periods. It is very important to stay invested, because if you sold off during the peak of the crisis when the market was down 34%, you would not have participated back into this rally that you're seeing right now. Now, again, going forward, we don't know how the market will grind in terms of on a look forward basis. But in general, if you believe that the pandemic will come to its logical end in a couple of quarters, once the vaccine results are more positive, and in general, with all the different stimulus programs, the economy keeps plodding along, we should see the market sort of normalizing and the markets continue to go higher up. Now, compare this with the global asset class returns as well. One thing to notice, there's a pretty busy graph, but one thing to notice in this graph is that no one asset class has outperformed consistently over year. This fact is basically mentioned or shown in terms of the different colors that you see at the top half of this page, where essentially every year or every other year the top performing asset class changes. And this year has been no different. Essentially, because of the pandemic situation, some of the large cap stocks have done well. So the US market, particularly the large cap US markets, have outperformed, given that during these uncertain times, they had better access to capital, they had much more stable revenue streams, and particularly some of the large caps tend to be also the more COVID-proof sectors, including technology, healthcare, and other sectors, which have continued to grind higher. On the other side, if you look on the YTD side, right, the column that is marked YTD, you see that small cap stocks have not done that well. So that's on the orange. Developed market equities, including Europe, have not been faring so well as well. Emerging markets there has been a disparity in terms of returns, while emerging market in Asia have started to rebound. Emerging markets outside of Asia has continued to struggle. Similarly, commodities and REITs continue to be challenged in the current environment. As I said earlier, there has been a strong rebound in terms of global asset class returns. And this graph particularly talks about the year-to-date returns and also returns from June 2009 to 2020 onwards, right? So the graph basically, the reason it is shown this way is to show you what are the sort of asset classes that have had the maximum rebound post the crisis. So again, if you look at the top performing asset classes, where it is the US equities, the Asia ex Japan has been on a rebound since the second half of this particular year, and led by China essentially, because they are the first economy to sort of come out of the pandemic in a fashion that has sort of inspired the other side of the world as well, that and has kept the prospects of the global economy to continue doing okay and not have the deep kind of recession that was anticipated previously. In terms of actual factors, quality and momentum have outperformed value as well as minimum volatility. So value is, again, sectors which are typically demand heavy. These are the sectors which, had borne the brunt of the coronavirus. These sectors include travel, these include oil and gas, banking. All of these sectors continue to be challenged, while there has been some recovery, but year to date, these sectors remain negative in terms of overall returns. Even Europe and, as I said earlier, emerging market ex-Asia continue to be challenged, and that's where both of them are negative year-to-date returns for now. Now, I think the most important question that all of us have in mind is the path to economic recovery. And to that extent, if you look at the latest World Economic Outlook, the global outlook and the global GDP growth is projected to be down 4.4% for the year 2020. And this is a much less severe contraction than was previously forecast by IMF. So this data has been provided by IMF. It was released just a couple of weeks back. And the revision in terms of the negative GDP growth number is sort of reflecting the better than anticipated second quarter GDP outturns that has been mostly observed in the more advanced economies, where activity actually began to improve sooner than expected, right after the lockdowns were eased. And in general, there are indicators of a stronger recovery into the third quarter as well. Now, global growth is projected to grow at 5.2% in 2021. And this is consistent with expectations that, even in 2021, and it's coming off a low base as well. That is something that we have to realize, that after, going down 4.4%, the market's rebounding 5.2% in 2021, basically tells us that, while there will be a recovery and the GDP growth numbers will start to, go back to on a positive trajectory, there remains this concern of whether social distancing and other such measures will remain in place in 2021. And if those remain, and there are more like services sector industries which will get affected because of that, the recovery might not be as broad-based as as one would expect, right? So 2020 looks like 5.2%, but broadly, I think after 2021, things will normalize to about 3.5% growth in 2022 and beyond, right? Now, if you look at the economic rebound, it has been faster than expected, but it is also prone to setbacks. So the global economy has generally emerged from one of the deepest recessions over the last century. And if you look at the manufacturing numbers, which is indicated on the left-hand side chart, which is figure 1.1, there has been a sharp recovery in terms of the PMI numbers, which is a indicator of how the manufacturing activity looks like across the globe. And if you see this, the first round of recovery was basically led by China, which is the light blue graph, where in early Jan, Feb, and March is when it sort of took a dip, and then essentially it started back on its upward trajectory in April and beyond. And then rest of the world essentially followed and is showing similar trajectory as well. So while the PMI numbers show a strong resurgence, we also need to look at other more high frequency data in terms of thinking through how the economy is going to level off going forward. Now, given that how severe the whole recession was, and that fact that we don't still have a permanent cure to the virus yet, I expect that the economic recovery should be more gradual in nature. So all of these are sort of, fairly good in terms of, the numbers that we are seeing and the recovery that's been happening. But these are all prone to setbacks given, the virus resurgence as well as potential cure for the virus overall. Now, I think the same thing applies to unemployment numbers as well. So the unemployment numbers had spiked to close to 15% in April as more than 22 million people lost their jobs, right? And although there has been a sharp recovery in the jobs thus far as well, the second half of the labor market recovery is much likely to be slower as well. And again, this is similar to what we covered earlier in terms of sectors which will have a hard time reopening if the pandemic continues. These include leisure, hospitality, travel, retail, and food services industry. So while most of this unemployment data, which has started to look better, most of it is driven in the more non-services oriented industries like industrials as well as technology and other sectors. But if you look at the demand heavy sectors, they continue to be challenged, and that's where the unemployment numbers for it to grind down lower to the target that Fed has usually of 4 to 5% will be a much more gradual process than what one would expect. Now, I think the biggest reason why we have seen the kind of rebound in the markets is mainly driven because of the fiscal policies that have been put in place. The global fiscal response in the pandemic has been unprecedented. The fiscal measures, if you measure as a percentage of GDP, it is close to 12% of the global GDP. So as much as $12 trillion has been pumped into the global economy to support wide-ranging activities from health spending, non-health equities, guarantees, and other activities as well. If you look at the most advanced economies, which is marked as AEs in the left-hand side chart, the total fiscal support that has come in form of the GDP support is close to 9% of the economy, right? And another 11%, which is marked on the blue bar, has come in as liquidity support, including equity injections into the hardest hit economies. So the right-hand side chart basically tells you how the money has been spent and which sort of sectors have sort of benefited through these spending programs that has been put in place by the governments across the world. There's also been a divergence in terms of how these fiscal support measures have been put in place with respect to the developed or advanced economies versus the more emerging market and middle income economies per se. So if you look at the EMMIE, that is the emerging market as well as the more middle income economies, the total fiscal support in terms of GDP has been more like a total of 6%. Out of that 6%, 3.5% has come in through like a direct support, and the rest 2.5 odd percent has come in terms of the liquidity support that we have talked about earlier as well. And similar to like what you observed for the more advanced economies, there were much more monetary stimulus programs as well as spending that the government did in terms of directly benefiting end consumers and business owners as well as people who lost employment and who were sitting in the sidelines. On the lesser advanced economies and emerging markets, what has been observed is they might not have had the same kind of stimulus measures in terms of their capability. They have gone a different route in terms of how they have helped the economic recovery to take place. And that's mainly driven through public works, typically aimed at infrastructure, investment to support the economy, right? So that's where if you see on the right-hand side chart, the red bars will see, the public works to be on the higher category for, G20 EMMIEs. So which basically means the more, middle income and emerging market economies spending most of their, things in those areas. Now, in terms of actual measures that have been put in place, the fiscal support actually, has also resulted in the global debt levels of all of these economies to go up much, much higher than what they were previously. So if you look at the advanced economies, the public debt levels have increased more than 20%. The emerging markets a little less so, as I was covering earlier, about 6 odd percent, and the low income economies to far lesser percent as well. And what that has also meant is the fiscal balance has also become more and more negative. So if you look at, again, the advanced economies have taken most of the fiscal deficit in their stride and continued to support the economy in the near term. The emerging markets and the low income developed countries have taken like a smaller hit on their fiscal balance sheet in general. Now, I think the most important part that everyone has in mind is what are the risks and implications of this COVID crisis and what is the path forward? The biggest question that all of us have is what is the path to economic recovery, and when is the functional end of COVID-19? There are three cases that has been listed out over here. The most likely case is what is right in the middle, which basically means that the functional end of the COVID-19 is projected to happen somewhere in Q3, Q4 2021. And that would basically mean that COVID-19 vaccine is authorized by either end of 2020 or early 2021. This also would require that the COVID-19 vaccine is made available fairly in a sufficient manner to cover a good amount of the population in general. And that time frame is usually like 6 odd months. And the third part being the willingness for a broad-based acceptance of the vaccine as well. So if all of these things do happen, then we are looking at somewhere around Q3, Q4 2021, when the pandemic will come to its logical end. But if any of these are delayed, that's where the actual pandemic end would sort of shift much later to 2022 or even beyond. Now, I think one thing that everyone has started worrying about again is the resurgence in the COVID-19 cases right now, where if you look at more of the US cases, the confirmed cases have started to go back up higher. If you look at the blue line, in April there was the first peak, and then in July, August it started to go back up higher. And it started to trend down again in September, but over the last couple of weeks, you've seen that the number of cases has trended to again be around 50,000-60,000 cases on a daily basis. So there is definitely a resurgence of the virus that is happening right now in the US. And that has brought some uncertainty in the market and also a lot of concerns going forward. Having the virus sort of starting to peak up, there has again been some speculation that will there be another lockdown situation, and will that again have bearing on the market going forward? But if you look at the data here, it's a little bit of a technical chart, but the way to basically look at it is the green dotted line versus the orange dotted line. The green dotted line basically tells that how has the mobility or economic activity been if the number of cases has started to increase or decrease. So typically before July, what happened was if the number of cases were starting to keep going higher, the economic activity took a hit because more and more countries implemented lockdowns, and what that meant was the economic activity was muted. But July onwards, what has happened is there have been more precautionary measures that the different governments have put in place as they have better visibility in terms of how the virus sort of grows and spreads. So they have put in more precautionary measures without needing to close down the whole economy per se. And what that has meant is July onwards, the change in economic activity or mobility has not been affected that drastically compared to what it was, pre-June. So I think that gives you some sort of optimism that going forward as well, because of this greater visibility in terms of how the virus spreads and, all the different governments implementing measures to control the spread of the virus, we can operate in an environment where, the virus might be spreading and, the resurgence is here, but we don't really need to lock down the entire economy to, contain it. So that's something I think optimistic in terms of going forward. And hopefully if we have the virus, sort of vaccine coming in over the next couple of quarters, things will look even better. Now, I think the biggest elephant in the room is, of course, the US elections. And this is something that, if you looked at what happened yesterday into the markets, the broader markets, especially the US S&P 500 and Dow Jones, and even the NASDAQ fell by more than 3.5%. And this was, again, on the back of a lot of uncertainty, coming close to the US election timeframe, which is, just a week away now. And if you look at this particular graph, it basically talks about the implied volatility, which is usually a fear indicator of how uncertain the market is, and investors' concerns about things looking uncertain going forward. So the general positioning of this implied volatility measure is that as we get closer to the actual election day, the volatility will keep grinding higher to the level, as much as 40. And then once, the election is over, things will normalize post, say, late October, early November period, and it will come back down below 30 levels. So this is, again, an indicator that we watch fairly, closely, because in our own portfolios, we do have a mechanism to, sort of have the portfolios constructed in a manner such that when there are high periods of volatility, the portfolios are positioned a little bit more conservatively to make sure that you do not bear too much downside risks in your portfolio. So it's very important to have a note of how the volatility looks like going forward, and how do you sort of guard against this volatility and brace for it as well. Now, I think there are different scenarios that can happen in terms of the outcome of the US elections. And if you look at the left-hand side, the top 3 rows basically talk about the different outcomes, where essentially if Trump comes back to power with a divided government, or Biden comes to power where there is a change in regime, there are two, again, situations there as well, where if Biden comes in, but the, government is still divided, where the Senate is still, say, controlled by the Republicans, or if Biden comes in with a united Democratic control, where both the houses are controlled by them, then there would have, there will be different implications to the markets and the economies in general. I would have to caveat that, whoever wins, in general, we place too much importance to elections. But historically speaking, if you go back and observe during different elections and different election periods, typically, yes, there is increased volatility going into the elections, but once the elections and all are over, broadly, the markets come back to normalization and they continue to rally going forward. But, again, from a near-term standpoint, there are certain things that we need to be aware of in terms of, if these situations were to take place. So in terms of fiscal stimulus measures, if Trump were to remain in power, it will generally be positive from a fiscal stimulus standpoint. And right now, again, there is $1.7 trillion package of stimulus that is just waiting for approval. And again, the crash yesterday was also partly driven by the uncertainty surrounding that fiscal stimulus program. Now, again, if Biden were to come into power, but with a divided government, it will generally be a negative for the fiscal stimulus programs, because again, there will potentially be some roadblocks or some negotiations that they will have to do with the Republicans to bring them on the same table. But if there is a united Democratic front, that's where the stimulus programs look much more promising going forward. Similar coverage from a public investment standpoint. I think the biggest thing that people are looking at is from a taxation standpoint, because if the regime does not shift, then most of the tax related changes that were done by the Trump government will remain. So even with a divided government, because then it will be hard for the Democrats to change those tax related things just with a half the house in their side. So only in case that there is a united Democratic control, that's when we are looking at the repealment of some of these taxation benefits that were given during the Trump regime. And that might bode a little bit not so good for some of the large cap companies and also the technology sector in general. From a regulation standpoint as well, again, if Trump remains in power, there is not supposed to be much change. But if Biden comes in, some of the antitrust measures and regulations might come into play, which can be technically negative in the near term for the technology companies. On the foreign policy and trade policy front, generally Trump has been much more following a much more protectionist strategy. We believe that if Biden comes into power, then there will be some relief in these sort of protectionism measures, which basically means that it will bode well for emerging markets assets going forward. I think I'll just pause a bit here because I think this is an important point in terms of US elections and how that can have implications more broadly. So Melvin, if there are any questions, happy to take them. Melvin, you're on mute.
Right. So I think generally people want to know whether if Biden win is bad for the markets. But I think you pretty much addressed it already. So on the next case in point is that, what's your thought on the stimulus actually, since you have the fiscal stimulus on the screen?
Right. So essentially, as I said, broadly, just to address back the previous question as well, even if Biden comes into power, I think there might be some sort of measures which might be negative in the near term for the market, because if he's going to repeal some of the tax-related incentives and benefits that were given during the Trump regime, that potentially might have a negative sort of impact onto the market. But broadly, whoever comes into power, I think one thing is clear: they will make sure that there is a broad level support to the economy. They cannot afford to have an economic downturn sort of ravage through the daily livelihood and the prospects of US in general. So I think whether Democrats are in power or the Republicans are in power, what I can say is that both will have a full-fledged focus on continuing the fiscal stimulus measures, which means that the $1.7 trillion package that is currently being discussed might get pushed a little bit further ahead, but that doesn't mean that it'll get derailed per se, right? So in general, the idea is the stimulus measures will continue, and that will make sure that the broader markets remain supported.
Great.
Does that answer, Melvin?
Yep, definitely. So I think you move on to the next slide first, and then I'll ask another question about that.
Right. So I think we talked about the stimulus programs that has been run by the government from a fiscal standpoint. At the same time, there has been the Federal Reserve, which has taken a very strong action to support the economy, including cutting the Fed funds rate to almost zero levels and doubling its balance sheet as well. So this sort of coupled with the Fed's willingness to buy bonds in unlimited quantities has enabled the federal government to deploy one of the most aggressive sort of fiscal stimulus programs since the World War II. Now, again, the onset of a recession combined with the collapse in oil prices has triggered a decline in the already low inflation, right? Like, overall, as the Fed funds rate have, kept on grinding lower, what has been the talk of the town is, would it actually impact inflation? And would it actually, grind higher as we move, forward? This is the same concern that was put in forth during the financial crisis as well, where, the point was that if there is so much stimulus programs being run and there is so much debt accumulation, plus there is so much money printing that is happening, will it actually lead to, overheating in terms of inflation numbers? And will the government then need to take back some steps to increase the interest rates again to contain it per se? And this, I think, compared to the global financial crisis, I think the situation right now is a little bit different. And the reason for that is essentially, the potential for further economic stimulus. There are extra costs associated in terms of operating during a pandemic, and the likelihood of an economic surge post-pandemic, might drive the inflation numbers to 2% plus levels, which is the Fed target, in a much shorter time period than is actually anticipated. So this is something that is definitely a little bit more concerning, and will also potentially result in the US dollar continue to weaken as we move forward. because, in terms of economic support, if these broad level fiscal stimulus programs continue to be supported, there will definitely be an impact in terms of how the real yields look like, which is already sub-zero right now. So even though the nominal yields are contained between 0 and 1%, the real yields are already negative. And what that means is the inflation rate has started to trend higher. And if you look at the green line over here, 2020 right now, inflation is looking close to around 1%. But going forward, it can quickly go back to 2% odd levels, which then would mean that the Fed would have to take measures in terms of maybe increasing back the interest rate, which can again have a negative impact broadly to the risk assets, and also will reverse some of these reverse some of these broad level recovery in terms of the global markets per se. Now, I think before I move on to the next section, again, Melvin, just pausing a bit to see if there are any other questions.
Okay. So I think one question is that when you touch on the stimulus, the amount of US dollars that's going to come into the markets, should investors be concerned about FX risk when they are investing, in Sing dollars, and we have to actually convert them to US dollars, right?
No, I think that's a great question. So in general, yes, I think there is a definite heightened FX risk if you're investing, if you're a Singapore dollar based investor, and the only solution to that would be to diversify into not just the US market but markets across the globe. Especially, I think some of the emerging markets look a little bit more interesting compared to how the US market is looking. So if you're looking from a going forward basis, I think one way to sort of address the FX risk that is prevalent and might impact your returns from a USD standpoint would be to diversify across the globe into other countries as well. Having said that, I think the US market continues to remain supported. Overall, the equity markets, if you look at the historical returns, the US markets has continued to have a preeminence in terms of overall returns. So while, yes, the currency impact might be negative for a Singapore dollar-based investor, broadly, I think the choices are fairly limited when it comes to growth assets and investment opportunities for us as well. Because, if you're investing into, say, the STI index, which is the local Singapore equity market, the returns have actually been negative from a price return standpoint over the last 10 years. So if you compare that with the US market and the same time period, the markets have more than tripled in the same time frame. So even though the US dollar has depreciated against Sing dollar over the last decade as well, if you were investing in a Sing dollar based equity portfolio versus investing into a globally diversified portfolio, you would have had much better return from that global pool of assets, right? So I would continue to encourage investors to look globally and contain some of this FX risk by diversifying outside of US a bit as well.
Maybe another one. What is our take on bond prices? Currently they have been like close to a 30-year bull run due to constantly decreasing interest rates, right? And given that our global portfolio has a very large allocation towards bonds, how would that actually affect the bond-heavy portfolios?
Right. So see, I think generally speaking, the bond prices are right now anchored. And the reason for the anchoring of the bond prices is mainly, again, the Fed policy in general, where, alongside reducing the interest rate, they have, put in this mandate of buying unlimited quantity of bonds in the market. What that means is essentially, I don't see the bond market to have too much volatility or have too much downturn even going forward. So the policy sort of stimulus measures as well as the support will remain going forward as well. What that means is overall, I would look for quality within the bond world in terms of what you invest into. Generally speaking, some of the high yield investments or high yield bonds, especially in the emerging markets, have started to look a little bit better. But broadly, I think the interest rates have been sort of contained. It is very hard to generate substantial yield from those bonds in general. So in our portfolios, the job of the bonds is mostly to contain the downside risk of the portfolios. And that's why most of our bond exposure is, government bonds and treasuries, which actually has been very, 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 very supported from the Fed and the central governments. And what that means is they will continue to keep your portfolio stable during these uncertain times, because the only asset class which is not anchored right now is the equity market, and that's why you're seeing such a high fluctuation in those markets per se. So as I said earlier, alongside investing into an equity-based portfolio, if you have diversified yourself into some of these other asset classes as well, it will help you smoothen your journey in terms of how you ride through this uncertain time going forward as well. So definitely, I think continue to have that bond exposure, but go for more quality assets within the bond world.
Great. Shall we do one last one before you proceed?
Sure.
Great. So what do you think might be the worst case scenario going into the next quarter?
All right. So I think the worst case scenario, I think, is, I think I covered it a little bit in terms of the different, scenarios that can happen in terms of the logical end to the coronavirus crisis. And the worst thing that could happen is the vaccine development that has been happening so far. The results are not so good. And what that means is the global economy, continues to remain a little bit, strangled in terms of, how open it can be. So while, more and more economies are trying their best to open up and also allow for travel, in terms of bubbles, all of these activities will remain muted unless and until there is a real solution in terms of a vaccine coming into play. And what that means is essentially any delay from a vaccine development standpoint will also mean that the recovery that we are seeing right now taking place will be more and more muted going forward, because all these fiscal stimulus programs that has been run by the government, the monetary stimulus programs that have been run, have contained the situation for now for a temporary basis. But for a sustained upturn in the global economic situation, there needs to be a proper solution to the virus. And that basically means that if the situation doesn't sort of remain optimistic in the next couple of quarters, we are looking at a much, much later end to the whole coronavirus situation. And what that could mean is, I'm not saying that it would be like a Great Depression like 1930s, but there would be a situation which maybe we are not completely prepared for. So that's, I think, the more pessimistic view on the market in terms of how it can play out. And yes, we should remain guarded against that situation as well. But again, one thing that all of us should realize is, as part of our natural tendency, we always find a way to survive through these different pandemic situations or various sort of challenges that are thrown to us as humankinds. So even if things are delayed and stuff like that, I remained optimistic from a very long-term standpoint that we will find other ways to contain it. And though the recovery might take a little bit longer, from a long-term standpoint, we will survive and we will get over it.
All right. Thank you for your answers, Ritesh.
All right. Awesome. So let's, I think, look at the markets in general and how do you position yourself going forward in terms of your investments, and where are the opportunities right now from an investment standpoint as well. So firstly, I think, as I covered earlier, let's first look at the US equities in general, right? So before I go into this slide, the US equities in general have recovered very significantly from the March lows and also at a record speed, right? Now, all of that has been good, but as the markets, look through the virus and the downturn from the downturn to the recovery, one thing that, is, looking a little bit not so great is the valuation front. So the US equity valuations are well above historical averages. Now that's a little bit concerning, but what you have to also realize is the high valuations are basically on the back of the muted earnings that you've seen over the last couple of quarters. If you normalize these earnings from a look forward standpoint, the valuations don't look that that high in terms of the historical average numbers as well. So while the markets may experience volatility ahead, and the risks of the virus resurgence and delays in vaccine development and all are still there, plus the election risk that, right now can have a near-term impact, I believe that, still from an overall low interest rate environment and the support from the Federal Reserve, all of these will make sure that the broader markets remain supported in the US, equity markets overall has some sort of, grounded, downside in general. So I don't think, we are going to go back to the levels that were seen in March 2020, where the S&P 500 cracked up 34% and went all the way almost close to $2,000 level. But there might be some near-term corrections, and in fact, those will be opportunities for you to add more to your portfolios in those downturns, right? So I definitely think that the markets will remain supported from a broad level standpoint. The worst is behind us, but we have to brace for the volatility that lies ahead, and these volatility will actually be opportunities, and especially for people who have remained in the sideline, have missed all the rally that was, that has happened over the last, 4 or 5 months. I think this could be a good opportunity for you to re-enter the market per se. Now, in terms of, some of the more factor-based performance numbers within the US markets, over the last decade, there has really been an outperformance of growth-related stocks as well as large cap stocks. Now, of course, if Trump were to remain in power, not much is going to change, and all of these sectors will continue to outperform because none of the tax-related things will be having any effect. Plus, in general, the broader markets will remain supported through the fiscal stimulus measures. But if there is a full democratic sweep, that's where the growth sectors will have some challenges because potentially there will be some regulatory effect and antitrust effect on the tech sector. Plus, there might be some tax implications, which again can have an impact on the large cap names. So all the gap that you're seeing right now in terms of the broad level indices, which is say the S&P 500, with on the left hand side it compares against the equal weighted index, which is S&P 500 equal weighted, the yellow line. And as you can see over the last year or so, the S&P 500 has outperformed a value weighted kind of index per se. That can reverse if there is a full democratic sweep. Similarly, if the large cap stocks have outperformed during the pandemic, if the tax implications and all take place, plus the Biden government is basically more pro stimulus package in terms of having the effects of those policies give bigger benefits to the smaller companies in general, that can have a net positive effect on the small caps as well. So these are two things that you need to be, or we as investors need to be a little bit more cognizant of, so that if we have too much exposure to technology or growth oriented sectors, maybe it's a good idea to pare down those exposures a little bit on a look forward basis. Similarly, I think international stocks has been, again, talked about quite a fair bit, where essentially if you look at them from a valuation standpoint, they look, sort of relatively attractive. And again, if you look from a historical standpoint, the emerging markets, which is on the left-hand side chart, the comparison here is price to book ratio, and the comparison again is against the S&P 500. So the emerging market, markets, the price to book valuations look a lot cheaper relative to S&P 500. Now, again, this has been the case over the last full decade, right? Like if you look at this number, the price to book numbers of emerging markets have looked attractive vis-a-vis the US market for the last one decade per se, but that has not really actually translated into better returns from the emerging markets. And that's what has been the prediction for almost 5-10 years now, that emerging markets are supposed to come back and outperform the US market. But so far the US has remained in a preeminent position, and most of the global returns have been driven because of the US stock market in general. But that is one trend that can potentially in a post-COVID world reverse, and that's why I think overall, as I spoke earlier as well, it actually is not a bad idea to diversify outside of US in terms of your overall investments as well, right? And that goes, same thing for the developed market equities as well. In terms of valuations, they do look cheaper, and developed market usually referred to more like European nations. And right now they do look cheaper. But again, the fact is that from an actual return standpoint, these cheaper valuation has not really transformed into actual returns. So again, these are a little bit more speculative that just because valuations are relatively cheaper, I should actually invest into these particular economies or these particular countries. But I think right now the reason you should also consider investing beyond just the US is more from a diversification standpoint, if not from a valuation standpoint. Right. And I think that's what I think in general, the biggest advice that I would have right now for every one of us as an investor is to diversify, diversify, and diversify. Right. So, no one asset class, as I had covered earlier as well, has continuously given you an outperformed return year over year over year. And that's what like the top, row has shown, that no one color dominates the returns. So it is much, much better for you to have a diversified portfolio such that, if the risks from one particular asset class or one particular geography is too heightened, it gets mitigated by, another asset class which is uncorrelated or, oppositely correlated to the asset class that has heightened risk during certain times, right? So again, if you look at the white block, that's the diversified portfolio. So while the diversified portfolio might not give you the highest possible return, but it guards you against far more negative returns, which I think most of us are concerned about. Right. I think on top of that, it is very important to also think about downside risk. This is a topic that not everyone understands in a very clear manner. The very important part to notice is if you construct your portfolio in a manner such that you can protect your downside, that will make sure that you don't really need to recover much, much higher in terms of being a participant on the upside as well. So for example, in March of 2020, the S&P 500 dropped by 35% or 34%, right? For you to recover back, so if you had $100 invested into the market in February, that $100 would have become $66 by March 2020. For you to go back to 100, you would have needed $34, which is 50% return to go back to even. So the more you lose, it is much, much harder for you to recover because the recovery needs to be much, much higher in terms of actual numbers. So that's why overall, if you can construct a portfolio in a manner such that you can contain the downside, the recovery needed will be much, much lower, and you will have a smoother ride to achieve your different investment goals as well. So again, that is sort of shown in the left-hand side chart that if you lose only 10% instead of 30%, you only need an 11% recovery to go back to even. So this is something that we again take into account during our portfolio construction process, especially in the global portfolio that we offer to our clients. So that's something that you could consider, especially in these uncertain times. Last but not the least, stay invested. I think, again, this chart goes to show that the longer you invest, the less chances you have in terms of having a negative, investment return experience, right? So on the top, you see that when you invest for 1 year, there are years then when you actually get higher returns and you have positive returns, but there are also years where you can get negative returns. That's the red bar. But as you invest for longer and longer tenures, the red bars continue to disappear to the extent that in 20 years, if you invest for any 20-year period, and this data is going back 150 years. So if you would have invested historically any time for a 20-year period horizon, there would not have been a single 20-year period where you would have lost money if you invested into the stock market. So I think this slide basically goes to show that the longer you invest, the lesser the chances for you to sort of actually lose money. So alongside all the things that we talked about, where those things will help you in terms of making sure that you don't panic and sell out, the other most important thing to note is you should remain invested through the ups and downs of the market to basically make sure that you don't miss out on the rebounds and the long-term sort of capital appreciation of your assets and compounding of your returns as well. Right. So in summary, if I were to wrap up today's session, yes, the US elections are coming, so you should brace up for the volatility. But please do not panic whether the Democrats come into power or the Republicans. there might be some short-term implications of it, which is reflected as part of the high volatility that you're seeing in the markets right now. But on a more longer-term basis, whoever comes to power, I think from a stimulus standpoint and market support standpoint, most of those policies will remain and will keep supporting the global markets in general. US equities, the policy tailwinds will continue to support it. Look out for factor rotation, especially if there is a democratic sweep of the US elections. International equities, the valuations look cheap. They have remained cheap for an extended period of time. Now, whether that actually translates into relatively higher return, only time will tell. But in terms of actually diversifying your exposure, it's not a bad time to actually add some international exposure to your international exposure to your overall investments, which can offer you long-term value in general, right? And again, last but not the least, diversify. I think that's the most important thing that I would like to highlight. Protect your downside risk and stay invested, right? So I think that's mostly it in terms of all the things that I wanted to cover from a economic outlook standpoint, as well as the risks and opportunities in the markets going forward. But let me pause here a bit again before I continue on the Syfe introduction side. Melvin?
Great. So I think an important question is that we spoke quite a bit on equities, actually, international equities. But in your opinion, are REITs still attractive?
REITs, you said, right? Oh, absolutely. So I think, sorry, I think I should have had a slide about REITs in general as well. I'm actually fairly bullish on REITs from a 3 to 5 year horizon standpoint. And the reason for that is, essentially, if you look at the markets from a broad level standpoint, while the bond market has remained anchored, but overall the yields have sort of died down. So, when as an investor, I'm hunting for yield and I'm hunting for greater returns, the only asset class that made sense till now is the equity market. And the equity market, till now has given far good returns, but is also prone to a lot of corrections in the near term. So from that standpoint, I think REITs sit somewhere in the middle in terms of the overall risk level that you are looking at. So they have components of equity because they're listed on the stock exchange, so their price fluctuates as well. But they also have components of some similarities with bonds because of the way they are constructed and the way they are required to pay out dividends based on their rental income in general. So from a risk standpoint, I consider REITs to be somewhere in the middle in terms of actual returns and yield. REITs continue to generate much higher yields compared to the bond investments. So right now, when people are struggling to generate much returns from their fixed deposits or money sitting in the bank, a natural alternative could be a combination of high quality bonds and paired with REITs in general, which is what one of our portfolios, which is a risk managed REIT portfolio, could be a solution to that regard. Now, again, REITs have also had challenges, and over the last 2 weeks, if you look at the Singapore REIT market in general, has also come off similar to the global and the US markets in general. But overall, I think if you look at things from a look forward standpoint, in Singapore more per se, as we see the phase 3 reopening about to sort of take place in Singapore, and in general, if you look at the REITs market as well, it is sort of broad based across different sectors as well. It is not just into the office and retail malls, which have sort of borne the brunt of the COVID crisis. So I definitely believe that the REITs will remain supported because there are some secular secular growth trends in certain REIT sectors as well. Like, for example, your industrial, your logistics, your data center, your healthcare REITs continue to remain fairly resilient, and they will continue to drive, decent yields going forward as well. Now, of course, there might be some rental reversions, which is, to the negative side on the office and retail malls space. But if you think that the phase 3 reopening is going to happen sooner than later in Singapore, that is generally a positive for these demand heavy sectors as well. plus, I think within office and retail, I see the retail side to be a little bit more challenged compared to the office, because Singapore is still a pretty contained landmass, and the limited availability of prime office space will continue to make sure that when Chinese companies and others are looking for space beyond say the US and other places, and they want to diversify out, and they're looking to set up businesses here in Singapore, those office space REITs will remain supported as well. So generally speaking, I think I'm fairly optimistic about REITs from a 3 to 5 year horizon standpoint. And in fact, the recent correction that you're seeing in the REITs market, I have been using it as an opportunity to build up more of my exposure to these REITs right now.
Great. So I believe just now we were talking about yield. So what about the outlook on high yield bonds? Would you prefer them over REITs or REITs over high yield bonds?
So I still prefer REITs over high yield bonds. So mainly because, again, REITs in general remain supported because of real rental income and some of these sectors within which the REIT exposures are. There is a little bit better visibility of how the businesses are, sort of bracing for the future in general. While on the high yield side, you really need to be really picky in terms of which high yield bonds you're picking up. Right. So broadly speaking, if you are looking at high yield without considering the actual, underliers and the credit risk posed by them, then it can be a recipe for disaster as well. So while high yield bonds, there are certain segments that do look attractive. I will be very careful in terms of selecting the right high yield bonds. For example, I would definitely not be, buying into a high yield bond, which is, say emerging markets, but non-Asia, for example, South American, related high yield investments. So I will be wary of those kind of high yield exposures per se. But broadly speaking, there are definitely some opportunities on the high yield side. But between the two, I like REITs more because there is also potentially some upside in terms of price appreciation over a longer term horizon. So they do have both the income component plus the growth component versus on the bond side, you're looking at more from a fixed income kind of exposure in general.
Great. So do you think that the US situation might spill over and affect the REIT market?
Interesting question. I don't have a particular view in terms of spillover effects of the US markets to the Singapore market and the Singapore REITs market more prominently. I think the broader implications will still be around the the global macro situation, things around the policy and the interest rates. So while the interest rates remain zero or close to zero, the REITs market will remain supported because typically lower interest rates are generally good for the REITs market because their cost of capital and the borrowing cost and all remain in check. So generally speaking, I will be more worried about the policy and interest rate environment rather than a direct sort of spillover effect of the US REIT market to the Singapore REIT market, because in a way, again, they are a little bit disjointed because we operate in a different part of the world, and Singapore again being a hub in the Southeast Asia region, which is still a very much growth oriented setup in general. I think these things will bode well for REITs over a longer horizon in general. Plus the fact that Singapore REITs are fairly diversified in nature, it will remain supported long term.
Great answer. So thank you, Ritesh. I think you can proceed on.
All right. So I think let's then proceed on to Syfe. I think how can you invest into Syfe and how can you use our solutions to solve for some of these opportunities, cater to some of the risks that we were talking about. I think we'll cover some of those in this section per se. Now, in terms of history, I think if you look at our company, the firm was founded in 2017. We got our license in 2019 from the MAS. And so far, we have then launched a lot of different products, which have been very well appreciated by the investment community in Singapore and beyond. And what has that meant is, we have continued to do very well. And even in a, COVID situation where most of the businesses have had a very tough time sort of remaining afloat, we remain very, very strong going forward. And that is sort of demonstrated with the 18.6 million Series A funding round that we recently closed in September, and goes to show that even big investors and global investors, strategic investors, see the potential in terms of what we have built, and see the trust that our clients have placed in us in terms of investing with us from a long-term standpoint. So I think we remain fairly optimistic. We are very, very excited about how we are positioned right now, and we'll continue to innovate both in product category terms, in terms of bringing you more and more innovative solutions to invest into the market going forward. In terms of the license, I think this is an important question that a lot of investors have, where they are concerned that if for some reason Syfe was to wind down, what will happen to my money and my assets? The good news is that Syfe has a retail fund management license. As part of this license, we are required to follow very stringent rules and regulations from MAS. And these rules and regulations require us to make sure that our own balance sheet and our own assets are kept separate from clients' assets. What that means is you don't bear a counterparty risk to us. So when you invest into Syfe, all your assets are kept separate into a trust and custody account with the likes of Citibank, HSBC, DBS, versus Syfe's own assets are kept into a completely different bank account. So in case something were to happen to Syfe, all your assets are still kept safe, and essentially you can redeem them in full, even if there is a counterparty risk or something were to happen to Syfe as a company. Now, I think quickly covering the different portfolio options that we have, what I want to sort of demonstrate here is that all of our portfolios have been constructed thinking from an investor sort of lens as to what are the problems that they're trying to solve for, what are the investment objectives that they have, and how do we align our portfolios to cater to those investment objectives in general. So right now we have three different portfolios: the global portfolio, equity 100, and the REIT plus. Now, typically, the broad level objectives that people have is either to grow their wealth. They want to grow their wealth either to achieve financial independence or retirement, whatever you might want to call it. They want to grow their wealth to fund their children's education, or they want to invest to buy a house. There could be multiple such goals that people are investing for, and they would want to grow their wealth to be able to achieve those goals in a dollar term per se. So that is one of the goals that is taken care of by our global and the equity 100 portfolio, which sort of take care of the more growth-oriented needs of our investors. And then the second goal or objective that a lot of investors have is to generate some sort of a passive income. And that's where the REIT portfolio comes in, where, as an asset class, REITs are, designed in a way to generate a good amount of passive income in a sustainable manner. And from that standpoint, I think it solves the need of a Singaporean investor to sort of generate a regular stream of income from their investments in general. Now, why do I consider the global and equity 100 to be the more growth-oriented portfolios? It's basically, I think, partly I covered it earlier as well. When you're looking to grow your wealth, you would typically want to invest into the equity market. And when you're looking into investing into the equity market, the Singapore equity market hasn't given that great returns. In fact, the return has been negative over the last 10 years. So when you want to invest and grow your wealth, you really need to think on a global basis. You need to invest outside of Singapore. And while that might mean that you take some sort of a currency risk over a longer horizon, even after accounting for that currency risk, you will be much, much better off investing in a globally diversified, growth-oriented portfolio than in a Singapore dollar local portfolio per se. So that's why I think the global and the equity 100 portfolio fit very well when you're looking to grow your wealth from a long-term standpoint. The difference between the global and the equity 100 is that the global portfolio sort of pairs the risk of investing into the equity market by also diversifying into bond and gold. So if you want to invest into the global into the global markets, but you want to make sure that your journey to achieving your goal is a little bit smoother and there is not too much volatility or fluctuation associated with your money, that's where I think the global portfolio could fit very well, because the bonds and golds, either they are uncorrelated to the equity or they are negatively correlated, which makes sure that overall your portfolio remains fairly resilient through the ups and downs of the market. The equity 100 is more like an alternative to directly investing into the stock market. And I think this is a popular portfolio for our investors in general, because it has a smart beta strategy, which ensures that we focus on maximizing the return. So of course, this portfolio is a little bit more risky compared to our global portfolio, which has bond and gold to stabilize it. So the equity 100 is high risk portfolio, but in general, that high risk also translates into much, much higher returns over a longer term as well. So the equity 100 usually exposes you to higher volatility, but in general, if you have the holding power, then I think over a long term, this could be a portfolio that can generate you much, much better returns than you directly investing into the stock market, where there are so much implicit cost of thinking which equity to buy, how much to buy, how to rebalance it, how to keep it optimized. All of those basically get taken care of with the equity 100 portfolio for you. The last is the REITs portfolio. And again, this is one of the most popular portfolios on our platform. This is a very unique offering. This portfolio has been built in partnership with the Singapore Stock Exchange, where they have licensed their REIT index to us. And this REIT index is called the iEdge S-REIT Leaders Index. It is one of the, again, more popular REIT indices in Singapore. As the name suggests, it contains all the blue chip REITs in Singapore, including Ascenda, Skeppel, Mapletree, CapitaLand, and ensures that it is diversified across the different sectors, subsectors, as we had previously discussed as well. So while the equity markets in Singapore hasn't given much returns from a growth standpoint, if you're looking to grow your money, but in Singapore dollar terms, you can basically also use REITs, not just from an income standpoint, but also from a growth standpoint. So typically, most of our younger investors invest into REITs from the standpoint of growing their wealth in a Singapore dollar non-currency exposure, non-currency risk standpoint by investing into the REITs portfolio and reinvesting the dividends to grow it over time. And our older, investors invest into REITs to actually generate that actual passive income that comes with the REITs portfolio as in the form of dividends. So again, I think, the combination of the three portfolios is done in a way such that it really caters to all the different needs that you might have from a long-term investment standpoint. And, it has opportunities for you to, invest in a more, diversified manner from a global portfolio standpoint, as well as take risks in the market by investing into the equity 100 and the REIT 100 portfolios in general. Now, I won't go into the details of these portfolios. I will leave that on the Q&A part of it. But I think what I will quickly cover is how can you sort of develop a broad level framework in terms of investing into these different portfolios, and how can you develop an overall framework to sort of invest in a more responsible manner going forward and a more resilient manner going forward as well. So I think throughout our session, we have focused on diversification. And I think the core satellite approach, sort of makes sure that while your portfolio remains diversified, you don't lose out on, opportunities in terms of capturing the upside of the market as well. Plus, the whole core satellite approach also goes very well with financial planning in general. Typically, when anyone is looking at their finances, there are two things that they want to optimize for. Number one is their, surplus cash that is sitting in the bank account, right? So all of us over years of, sort of working in our professional life, we have accumulated certain wealth, but we might not have invested it, optimally. So typically the idea is you should have 6 months of your expenses kept aside as emergency funds. So for example, if someone has say $5,000 of monthly expenses, the person should definitely have $30,000 set aside as emergency funds. But if the person has $100,000, in the bank account, that's really not optimal, because that money sitting there is earning you no interest rate, right? And is actually lying idle. So rather than that money lying idle, that money should really be invested as a lump sum. Now, a lot of people are afraid of investing a lump sum amount because they're afraid of timing risk. And that's where I think, again, this core satellite approach comes into play, where on day one, you don't invest into a very risky portfolio like equity 100 or REIT 100. You invest into a diversified core portfolio like the global portfolio, which has a combination of equity, bond, and gold. And you start smaller into the equity 100 and the REIT 100 portfolios, right? So that on day one, you don't have, too much of timing risk with respect to, one particular asset class or one particular, geography per se in general, right? So that could be like, the first part of your financial planning in terms of optimizing for your core, investments, as well as your lump sum money, which is the surplus sitting in your bank account. The second part is basically the monthly income and the monthly savings that you have going forward. And that monthly saving, again, should not go back to your bank account because, essentially you already have your emergency funds kept aside. So if you really want your money to work harder for you, you should actually be investing those monthly savings back into these portfolios to, number one, make your money work harder for you, but also number two, dollar cost average onto these investments and make, optimize your overall investments and make sure that, you are participating in the long-term, growth potential of the markets in general, right? So once you follow that, I think what happens is the core part of your portfolio is definitely, stable because it is diversified across asset classes. It is global in nature. Plus in our world, it is risk managed as well. And then the satellite part of the portfolio is where you're taking the risk and you want to participate in the upside, but you're mitigating the risk associated with these satellite portfolios by dollar cost averaging onto them as well, right? So I think in general, if you are planning to invest in a more responsible manner, but at the same time not lose out on the long-term growth potential of the markets and also capitalize on the different opportunities that the market throws at you, I think this could be a good strategy for you to follow. I'll quickly take a pause here, Melvin. Maybe we take a few questions if people have regarding our portfolios and the approach in general.
Okay, so one interesting one is that considering recent volatility towards equities, right, and you would expect further volatility going ahead. So do you suggest that clients shift their entire portfolio from equity 100 to global, or to actually wait till 2021 before they take on the equity 100 at all?
Yeah, I think, again, I don't know the full situation of this person in terms of, how the portfolio is structured in general. I think, again, if you look at this approach that I just highlighted in terms of having a core portfolio and a satellite portfolio, if you follow this, then you really don't need to sort of tweak your allocation on a frequent basis just because markets are, sort of volatile. The idea of the core satellite approach is to basically, cater to these uncertainties, but still, keep participating in the market and not be perturbed by it. So if you already had a core portfolio which was global in nature, then you wouldn't really need to shift your equity portfolio to the global portfolio because the idea is the global portfolio is already stable. Your equity portfolio is volatile and, potentially right now it is suffering a little bit because of the, recent downturn in the market that has been observed. But again, if you extend your time horizon, not just for a few weeks, but like, say 1 year, 2 year, 5 year, 10 year, that's when you will realize that it is futile to sort of keep attempting to time the market and coming in and out of the market in general. Because what if you shift out of equity 100 and then 2 months down the line, the whole market rallies again? How do you know when you have to come back? It is not necessary and it is not guaranteed that just after the US elections, things will normalize, right? It is entirely possible that, if there is a particular outcome, the US equity market rallies back. So do you want to really miss out on that? So rather than, doing these, speculative bets and shifting too much of your portfolios, I would encourage you to, again, follow a proper core satellite approach to investing. And in fact, opportunities and volatility periods such as this should be used as a way for you to sort of dollar cost average and, sort of buy more into equities rather than sort of, removing the exposure full-fledged, right? So again, make sure that you're not overexposed to just one asset class or one particular, sort of investment portfolio per se. Have these different portfolios or the combination such that you don't then need to worry about, oh, I have, 100% of my money is invested into the equity market. Then yes, I think you need to rethink if you're willing to take the, volatility going ahead. But if you already have a diversified portfolio, then you don't need to worry. In fact, these opportunities, these volatile periods should be used as opportunities to dollar cost average onto your satellite portfolios?
Great answer. Perhaps one more. So for the global portfolio, I think most people are wondering about the downside risk setting. So do they actually adhere by the results of it, or do you actually recommend that they, ask themselves some internal questions about like their internal like stop loss before deciding on it? So some of them feels like the question might be too simplistic or it doesn't ask sufficient questions, right? So do you recommend that they use our recommendation or ask themselves some internal questions? And if they should be asking themselves some internal questions, what questions should they ask themselves?
That's a great question, actually. I think definitely, our recommendation is, only takes into account what you tell us. So there could definitely be a lot of things that we don't know about it and that we don't know about you. And what that means is, there are definitely some internal questions that you should have in mind in general, before you choose a particular portfolio and move forward with it as well. And especially on the global portfolio, it is fairly easy to do that because there is a slider, right? And suppose in our, when you take the risk assessment and we tell you that, oh, you, for your profile and your investment, objectives, you should be choosing the 15% portfolio. And then you look at the portfolio and you realize that, okay, this portfolio looks interesting, but I think that, it didn't consider, my overall, assets, liabilities, my outside investments, which I already have. So maybe I, need to have more equity because, this is giving me this particular portfolio recommendation, assuming that I do not have any investments outside of Syfe, right? So always, have a holistic view of your overall investment. So for example, if you already have a lot of equity exposure and other things that you are taking care of through other platforms, then maybe you should take a lower risk on the global portfolio from our standpoint. On the other side, if you see that in your overall exposure, you have too much exposure to Singapore-oriented equities and Singapore bonds in general, then essentially you can have, you can cater to our platform with a more global approach in terms of having a higher allocation to the US market equity and the global market bonds as well, right? So I think some of these would be important questions for you to ask internally. How is your overall investment distributed in the current state? Because that is information that we do not collect from you. So definitely ask that question. One thing on top of that that you should also have in mind is, because all of our portfolios are downside risk, measured, so they are quantified in terms of how much risk you are willing to take. I think it is not fairly apparent that when you choose a particular risk level, in a way, what you're saying to us is, what is the maximum downside that you're willing to take or maximum drawdown that you're willing to take on your portfolio from a short-term standpoint? So one internal question that I always ask myself is, if in a short-term time frame, if the market corrects, whatever percent, 20%, 30%, what is the maximum sort of stop loss or, whatever name you want to call it, or drawdown that I want to have in my portfolio? If that is something that you can have in mind, how much is that number that you're comfortable with? That is another thing that helps me decide what risk level to choose, because in our case, the risk levels that you choose actually denote the actual downside risk that you're willing to take. So for example, if you choose 15%, you're telling that I don't want to have a drawdown beyond 15%, whether the market goes down 20%, 30%, or any number, right? So those are two potential questions that I'll ask myself in terms of my overall distribution of investments in the current state. And depending on that, how should I, design my Syfe portfolio and how much exposure should I have to all of these different asset classes from our offering standpoint. And number two, in terms of what downside risk am I comfortable with?
Great answer. Thank you so much, Ritesh. So perhaps you would like to continue first?
All right. So I think this is another case study that I think is, fairly exhaustive in nature. It's a more deep dive version of the core satellite approach that was mentioned here. So this is more of a fuss-free way to get invested, where if you don't want to think too much and you just want to get started, you can just, follow framework, something like this, and then start your investments with us. But if you want to do a proper planning of your investment, where you want to project your investments in terms of different investment objectives that you might have or goals that you might have, and each of those goals might have a dollar value attached to them as well, then I think this kind of an analysis might be suitable, where the goals might be retirement, children's education, buying a holiday house, passive income, having exposure to growth-oriented assets to sort of make sure you participate in the upside. All of these could then be translated in terms of how these individual portfolios will cater to the different goals and grow over time to sort of achieve the dollar value that you have in mind. Now, these kind of analysis are things that we actually offer on our platform, so you can actually schedule a time with our advisory team. And if you do have a lump sum amount to put in, where you want to plan your investment to cater to the different goals that you might have in mind, then I think you should definitely utilize our services to have a much more clearer view of how you're investing and how that investment will actually achieve the different goals going forward as well, right? So in a way, you remain a little bit more objective. It is a more planned way of investing, and it is a more committed way of looking at your investments as well, right? So definitely, if you're interested, on the Syfe website there is an advisory page, so feel free to schedule a time with us and schedule one of these sessions where we can do a proper financial planning for you, where we assess what's your current financial situation, what are the different goals that you have in mind, and what are the different portfolios that might be suitable to sort of align to those goals as well. Right? So in terms of getting started, fairly simple. Our Syfe, you can use our Syfe website to start your onboarding process, or you can use our app, which is available both on Google Play Store as well as Apple App Store as well. So if you go to any of these channels, you will be able to see a Get Started button. You can choose a portfolio. Once it will ask you a few questions. Based on the answers that you give, it will give you a recommendation in terms of what portfolio is suitable for you, or which option within a portfolio is suitable for you. Once you're comfortable, you can go ahead and create your account. Once your account is created, you can add as many portfolios as you want. You can create your whole core satellite portfolio framework. And then once you invest into them, you can track the portfolios fairly transparently in terms of what's the current value, how much return have you generated, what's the composition, all the transactions that have happened in your account, what dividends have you received, as well as any fees that have been charged to you, right? Now, in terms of pricing, again, very transparent. There are no hidden charges. It's an all-inclusive fee, which is the management fee that Syfe charges. There is no brokerage fee, no entry charges, no exit charges. There is no holding period. You can withdraw your money at any point of time without any penalties. We take care of all rebalancings, and the cost associated with those rebalancings are also taken care of. Plus, all the dividends are automatically reinvested. For REITs portfolio, you also have the option to pay the dividends on a quarterly basis to your bank account as a passive income. So all of these facilities and features are available free of cost to you. The only fees that you pay to us is the management fee, and that management fee varies depending on which tier you fall under. So typically, if you are investing less than $20,000, then the annual management fee is 0.65%. If you're investing more than $20,000, then it is 0.5%. If you are investing north of $100,000, then it is 0.4%. Plus, if the more you invest, the better access you get to the advisory team, and especially for Black, Gold, and Platinum tier clients, you have access to a dedicated team of advisors who will make sure that, essentially any questions that you have with regards to your portfolio, with regards to the markets, the outlook, you can ask them those questions. And also for Gold and Platinum tier clients, we will do regular portfolio reviews to see if there are any changing circumstances for yourself, or changing goals, or anything that requires some sort of a rebalance of your portfolio or reallocation to your portfolios as well, right? All right, so I think that's mostly all of the stuff that I had in mind today to cover. So I am not sure, there's supposed to be a promo slide as well. So Vivian, if there is that promo slide, if you can add it, I will showcase it to our clients as well. So that, there is a quick survey at the end of this session. So if you fill up the survey, you get to sort of get a, small promo bonus with us. And what that would do is essentially, one second, let me just refresh it, and that promo slide should come out. 1 minute. All right, yes. So yeah, please click on, or please take a snapshot of this QR code, and there's a short survey that will come. So once you fill up the survey, you can enjoy a 6-month fee waiver on your investments with Syfe. So I look forward to having as many feedback from all of you as possible. And again, if there were some questions that I could not answer, please feel free to add them in the feedback form so that we can get back to you as well. Melvin, do we have time for a couple of more questions, or is it already too late?
I think let's just address one, and then we can call it. Right. So I think it's on everybody's mind. So how is the equity 100 portfolio prepared for sectoral rotation? Given currently, tech is still taking up quite a big portion, and because you have also emphasized on the emerging market sector, right?
Great question, actually. So, okay, as mentioned earlier, the equity 100 portfolio actually has some factor considerations, and some of these factor considerations are value versus growth, volatility, and size, right? So, as during the market outlook segment, I did cover that there is some sort of sector rotation that you should look out for. It doesn't mean that those sector rotations will actually happen in practice. But at the same time, in our equity 100 portfolio, if you look at the latest rebalance that was done just a couple of weeks back, the growth allocation back then was actually 44%. So QQQ, which is the sort of allocation to our more growth-oriented asset classes, that allocation was 44% of the portfolio. Post the rebalance that was done a couple of weeks back, that exposure has been pared back to 30%, right? And most of that, reallocation has actually gone back to the broad level, sectors in general. What that means is some of that rotational effect, if any, has already been taken into account in this equity 100 portfolio, because now there is a greater diversification out of that growth sector that you had seen previously. And overall, I don't see from a long-term standpoint that the growth sector will not, barring like near-term challenges, from a long-term standpoint, I still remain positive on the growth segments, because these tech companies and now all have become sort of ingrained in our daily lives, right? 25+% of the S&P is now technology companies. So all of these have become part and parcel of our daily, habitat in general, right? So what that means is they will become more and more relevant. And because of that, you should not just, fully cut down on your exposure to growth-oriented asset classes and growth-oriented, stocks in general. But at the same time, growth stocks have risen quite rapidly, to the extent that now they are in sort of uncharted territory. And that's why in our case for equity 100, the exposure to growth sector has been reduced from 44+% to 30-odd%, right? And most of that rotational effect has now gone into sectors which are more stable and sort of counter-cyclical in nature in general.
Answer. So I think that's about all the time that we have for today. So for any questions that we don't have time to answer, do address it at our website. There's a talk to advisors function there, whereby you can schedule a call with one of us. So thank you, Ritesh, for presenting today.
So great having everyone here today. Please feel free to reach out to us going forward for any questions. As Melvin mentioned, we have an advisory page. So if you have, any particular, in-depth questions, feel free to engage with us. Also, if you want to do a planning session with us, do reach out. So again, there will be heightened volatility going into the elections, but please do not panic. Remain invested and keep your portfolios diversified. Thank you, everyone.
Thank you. Good night.
Good night.